Hello everyone. In today's video, I'm going to discuss about how different kind of investments are taxed in Canada. Tax season can be daunting time for many of us, but understanding how investment income is taxed can help you make better financial decisions and protect you from higher tax payments. In this video, I'll explain how capital gains, interest income, and dividend incomes are taxed in Canada. Let's start with capital gains. When you sell any capital property, which includes cottages, securities such as stocks, bonds, ETFs, and mutual funds, land, building, or any equipment used for business or rental operations, and when you make any profit out of it, that is called as capital gain. The good news is that only 50% of the gain is subject to tax. That means you get a preferential tax treatment from the Canada Revenue Agency. A simple example would be if you make a $10,000 in capital gains, only $5,000 is subject to tax. So half of the fruit of your labor you enjoy without paying any taxes. However, the other half is reported on your tax return as a regular income, so you pay taxes on it at your marginal tax rate. So the higher your income, the more tax you'll pay. For example, let's say you bought 100 shares of XYZ stock for $50 per share, totaling $5,000 in 2018. Then, in 2021, you sold all 100 shares for $75 per share, totaling $7,500. To calculate your capital gains, you would first need to determine your adjusted cost base by adding any expenses incurred to purchase the shares, such as brokerage fees or commissions. Let's say these expenses total $100, so your adjusted cost base would be $5,100. Next, you would subtract your adjusted cost base from the sale price to get your capital gain. Sale price minus adjusted cost base is equals to capital gain. Since only 50% of your capital gain is subject to tax, you would only need to report $1,200 as taxable income on your tax return. However, this $1,200 would be added to any other income you earned in the year and taxed at your marginal tax rate. If you've sold any of the capital property at a loss, you can use those amounts to offset some of the gains for the current tax year or dating as far back as 3 previous years. Losses can also be carried forward indefinitely to offset any future gains. But be careful if you are a day trader, because if the CRA determines that most of your income comes from the capital gains, then it might treat it as a business income, and then 100% of the gain will be subject to tax at your marginal tax rate. Now let's look at the interest income. This is the income you earn from securities such as bonds or guaranteed investment certificates, which is also known as GICs. Unlike capital gains, interest income is fully taxable in the hands of the investor. All the interest earned is reported on the tax return and taxed at your marginal tax rate, making it one of the least tax efficient investments unless held in one of the registered accounts such as RRSP or TFSA. Finally, let's discuss dividends. Along with capital gains, dividends also get preferential tax credit. However, taxes on dividends are calculated differently based on whether they are eligible or non-eligible. Eligible dividends are usually issued by publicly traded companies and come with a bigger dividend tax credit, whereas non-eligible dividends are issued by private small businesses. Let's look at an example to understand what is the difference between eligible and non-eligible dividends. To fully understand this example, you first need to understand what is a gross up rate. When a company makes a profit and pays dividends to its shareholders, the government takes some of that money as tax. The gross up rate is a way of making sure that government only applies tax on the part of dividend that has not already been taxed. It is like little extra money that gets added to the dividend before it is taxed, so that to make up for the tax money that has been already paid by the company. So basically, gross up rate is a way of making sure that everyone pays fair amount of tax on the money that the company has made. Easy, right? Let's say you own 1,000 shares of Company A, a publicly traded Canadian company, and they paid out $1 per share in eligible dividends in 2022. This means you received $1,000 in total dividend income for the year. Eligible dividends qualify for a dividend tax credit, which reduces the amount of tax you owe on the dividends. In this case, the gross up rate for eligible dividends is 38%, which means the actual amount of dividends you receive for tax purposes is $1,000 multiplied by 1.38, and that is 1380. However, you get a dividend tax credit of 15.0198%, which reduces the amount of tax you owe on the dividends. So, your taxable income from the eligible dividends would be $1,172.40. This amount would be added to any other income you earned in the year and taxed at your marginal tax rate. Now, let's say you also own 1000 shares of Company B, a privately held Canadian company, and they paid out $1 per share in non eligible dividends in 2022. This means you received $1,000 in total dividend income for the year. Non-eligible dividends do not qualify for the same dividend tax credit as eligible dividends. Instead, they have a lower gross-up rate of 15%, which means the actual amount of dividends you received for the tax purposes is $1,150. However, you get a smaller dividend tax credit of 9.0301%, which also reduces the amount of tax you owe on the non-eligible dividends. Your taxable income from the non-eligible dividends would be $1,046.16, and again this amount would be added to any other income you earned in the year and taxed at your marginal tax rate. Foreign dividends are generally fully taxed on your return, but you may be able to claim a tax credit if the foreign country withheld tax on the payout. Tax savings are a key consideration when deciding which investments are best held in various accounts, but by far it's not the most important factor. Risk tolerance, time horizon, investment goals, market conditions, diversification, and an investor's overall financial situation are other more pressing priorities in investment decisions. Alright, so I hope you found this video insightful. If you enjoyed the video, don't forget to like, comment, share it with your friends, and subscribe to my YouTube channel. That's it from my side, guys. I'll see you next time.